Welcome back, everyone. I'm here joined with my partners, Paul Radataket and Joey Krug, to help dispel some of the myths and misconceptions that we hear in the markets. The reason I want to do this is I've been evangelizing Bitcoin for 8 years, and in the early days when I would go pitch an institution, they would get, the CIO and all the staff, 8 or 10 people around the table. I do the whole pitch for an hour. I get to the end and nothing happens. And as you're walking out to the elevator, people go, "What's the minimum?" And so they were believers in their own heart and they were long personally, but they couldn't get it through the investment committee. So that's really the spirit of this, is to talk about some of those myths. So on the first slide, we have a bunch of the myths that people have put up. Luckily, I would say that we've, as an industry, kind of whacked through a lot of them. The first one is volatility. You often hear that Bitcoin's too volatile. How can you have it in a portfolio? It's got 75% annualized volatility. That is higher than a lot of things people invest in. A couple perspectives on that. That's still really tiny compared to its return. A popular measure of the quality of a risk-adjusted return is the Sharpe ratio, the ratio of the return divided by the volatility. And with a 213% compound annual growth rate, Bitcoin's not really that volatile. The other one is it has the same volatility as Amazon stock. So, equally disruptive, equally interesting thing, somewhat equally valued as well. So it's not surprising that at 75% volatility. It also has most of the volatility, the upside. In school, we were always taught volatility is bad. You have to minimize volatility in your portfolio. That's not true if you're long an option. And I've long thought of Bitcoin as an option on the future payment rail of the world. And so if you're long a call, you want to have volatility. With the unlimited money printing that's going on in the world these days, it's actually starting to seem like it is as well a put on paper money. So owning something that has downside protection in such a debasement of paper currency scenario is a good thing. The last point that I'd like to touch on, I touched on it briefly yesterday, is regulatory uncertainty. You hear that a lot from institutional investors, and it's obviously a very important fiduciary question to ask. The good news is over the years, most of the regulatory bodies have ruled, and it ruled quite favorably for cryptocurrencies. The IRS rules it as property. So if you hold a cryptocurrency for more than 1 year, you get long-term capital gains tax treatment. The CFTC has been very, very progressive. One of their commissioners came to our first summit in 2013. They have regulated futures since 2017. So the CFTC has been very, very strong. The SEC is really the only one left to rule. They've ruled that some things like Bitcoin are not securities. That's good to have clarity. They've ruled that a handful of things are securities, and then everything else is kind of in this middle zone. The markets de facto act as if all assets are, in fact, securities by US law. So most things take a year to start trading and are treated as if they are securities, but that's the one thing that we want to have clarified. And the incoming Secretary of State of Treasury has been very open to the fact that blockchain is bringing many benefits, and we have to focus on those. So the governments around the world have resolved most of the regulatory issues, and we just have the SEC security issue to be cleaned up in the next year or two. With that, I'm going to hand it to Joey to talk about the ESG implications of Bitcoin.
Thanks. So one thing people are talking about a lot these days is the environmental impact of mining. The concern is basically that Bitcoin mining is unsustainable and damaging to the environment. And there's a few things that people point out. One is that they point out that it consumes a large portion of the world's electricity. Back in 2019, it consumed about 20 basis points. These days, it's closer to 50 basis points, which is a sizable number. That's a lot of electricity. But I think one thing that's really important to point out is that roughly 3/4 of that is renewable energy. So if you think about the economics behind Bitcoin mining, the incentive is to use the lowest cost electricity that you possibly can, because that's how you make the most profit as a miner. And so for that reason, a lot of the mining power is renewable, hydroelectric power, wind power, in some cases solar power. Even a lot of the energy that's not traditionally viewed as renewable is energy that's excess energy that would have otherwise been wasted There's a lot of mining with what's called flare gas these days as well. That's energy that wouldn't have been able to be used in the first place, and it's therefore being used to mine Bitcoin. And I think over time, as electrical costs come down, more and more of it is going to be renewable. The other piece is that there are technical solutions to this problem. Ethereum is switching to proof of stake for a couple of reasons. One of the biggest ones is that it's more scalable, but another reason is that it's much more, better for the environment. It doesn't have the same sort of operating costs that something like proof of work does. And so we're seeing more and more protocols launch with proof of stake and switch to proof of stake as well. The next myth we want to address is about Tether. And so the main concern that people have with Tether is that Tether is, unbacked, and Tether is basically printing Tether and then using that to buy up prices in the market. And this isn't actually accurate. So one is if you look at it quantitatively, there's a couple professors from Berkeley that have looked at market inflows for Tether and other stablecoins, and basically found that there's no systematic evidence of stablecoin issuance driving crypto prices. The other aspect here is Tether itself just went through a big lawsuit in the state of New York. And as part of that, they found that, there were a couple of cases where Tether's bank account got frozen, but they did actually have the money in those accounts. They just got frozen. And then on an ongoing basis, Tether has actually agreed to do basically what are called solvency audits to prove that they actually have the reserves. And those are, underway and have so far shown that they do actually have the money backing it. So there doesn't seem to be any evidence that, someone's printing a bunch of Tether and then using that to buy up the market. Instead, it's genuine demand that is boosting the price of cryptocurrencies. The next one is about security. And so, it's kind of an old myth in the space that Bitcoin can be hacked and stolen easily. And the way I think about Bitcoin is it's sort of like gold. It wouldn't make sense for somebody to say gold can be hacked. Now, gold can be stolen. If you put a huge wheelbarrow full of gold, out in the middle, outside of your house, somebody might come by and steal it. And Bitcoin's kind of the same way. But what's not going to happen is the Bitcoin network itself is not going to get hacked. It's been proven to be very secure. The actual network itself has never been hacked. No one's ever, stored a Bitcoin securely and had their private key somehow be hacked. That's something that's just, for all practical intents and purposes, impossible. The probability of someone generating the same private key that controls the Bitcoin that you have is 1 in the power of 2 to the 256, which is an insanely large number. To put it in context, it's many orders of magnitude higher than the number of grains of sand on all of the beaches on Earth combined. And so it's a really large number. So all the hacks in the space to date have mainly been caused by human error, the equivalent of putting a wheelbarrow full of gold out in the street, as opposed to Bitcoin or its underlying blockchain being insecure in any way. And with that, I'm going to pass it to Paul. He's going to talk about some other myths in the space.
Thanks, Joey. So one of the myths out there is that Bitcoin or cryptocurrencies is only used for illicit activity. And so when I joined the space in late 2013, early 2014, I heard that quite a bit too. And the first thing that I would mention to my friends about Bitcoin would be around this sort of topic, because they would just ask me, well, isn't this just used for, selling drugs and Silk Road and what's associated with that case? And, I told them there's a lot of things that's going on that's outside of Silk Road. And so if you look at some of the reports out there, Chainalysis, one of the top forensic companies in the space, said that criminal activity represented about 2% of all crypto transaction volume, and versus what the UN estimates 2 to 5% of global GDP is connected with illicit activity. And so I guess two good examples of this is one of our investments, Zcash. It is a private cryptocurrency, a lot more private than Bitcoin or any of the other ones. And through their analysis, less than 1% of their cryptocurrency is used for illicit activity. So, if Zcash isn't being used for illicit activity, then, I can't imagine any of the other ones being used for illicit activity. And the second example that I would mention would be around just comparison to cash. I mean, cash is, way easier to facilitate illicit activity than using a transparent ledger. And so, Bitstamp, one of our companies, helped detect some of these illicit activities through the use of their exchange and blockchain. And next is crypto payments. So there's been a huge influx and minting of stablecoins, which we talked about in some of the earlier sessions. And with stablecoins, they are actually being used for payments. And one of the myths out there is that cryptocurrencies are not useful for payments. Right now, we're seeing in the emerging markets a huge influx of people wanting to store value in stablecoins. And from there, we're starting to see really large companies like Visa adopt stablecoins as a way to help facilitate cross-border payments. So far with our portfolio companies, we've seen companies that are focusing on remittances, and almost all of the transactional volume is being done using Bitcoin right now because it has the most liquidity. And we think that especially in emerging markets, whether it's going to be Bitcoin or whether it's going to be stable coins, payments are being done using cryptocurrencies, and that's really, really exciting. And I think on top of that, Tesla is now accepting Bitcoin for car purchases. PayPal is now accepting payments to their 29 million merchants, all in cryptocurrency. So we think that's really exciting. I'm going to pass it over to Dan to talk about market manipulation.
Thanks, Paul. We're lucky in our next session, we'll actually have the co-creator of USDC, one of the most popular stablecoins, join us. The next topic is market manipulation, and it brings me back to 2013 when we were looking at all the different structures we could possibly use to launch the first crypto fund in the US. We looked at all kinds of structures, including ETFs. We decided that we would use a Cayman Islands hedge fund structure, which is very common to most of you in the investing community, but with twist of making it daily liquidity so that our Bitcoin fund was very much like an ETF, because we thought it would be quite a while till an ETF would exist. It's 8 years later and an ETF still doesn't exist. Commissioner Hester Pierce of the SEC has spoken many times about what she believes is a double standard against crypto, holding crypto to a much higher standard than most other asset classes. The previous chairman of the SEC has said one of the two reasons why an ETF has not yet been approved is this supposed market manipulation. I've been trading in global markets for 35 years and seen some very strange things happen in different markets. The Bitcoin market is so much bigger and so much more liquid and so much harder to manipulate than basically every other market that's out there. There are ETFs in markets like palladium and platinum that have monopoly producers that really control the price. Those markets are much easier to control or manipulate than Bitcoin. An example I used in one of our sessions yesterday is that even before the craziness, GameStop was trading $70 million per day. It was trading that on one exchange in one country. Bitcoin trades 1,000 times more volume on dozens of exchanges in dozens of countries. So it's very, very difficult to manipulate. The other argument that you hear is there's no intrinsic value to Bitcoin or cryptocurrencies. There's no fundamentals. Had a fun debate with one of my Tiger Cub friends who's a TMT investor, and he said they don't trade Bitcoin because there's no cash flows to discount. That's true, but there are no cash flows to the euro either, and nobody thinks twice about trading the euro. You have to come up with frameworks for how to value Bitcoin. We've used in our investor letters over the last 4 or 5 months some supply and demand graphics and thoughts of how one could value it. I think that's the simplest way to think about it is Bitcoin and other blockchains are, they're sometimes thought of as commodities, sometimes thought of as cryptocurrencies, digital gold, payment rails. There's hundreds of use cases. It's kind of the miracle whip of finance. And so when you add all those use cases together, it becomes useful or has utility for more and more people. slide I showed yesterday is that every 2 years, the number of people using Bitcoin goes up by an order of magnitude, and potentially not coincidentally, the price goes up by an order of magnitude every 2 years as well. So that's essentially the way you can value it. The other perspective, you sometimes hear people say, hey, there's no intrinsic value. There is no intrinsic value to paper money either. They have been printing so many pieces of it that the British pound sterling, which obviously used to be exchangeable for a pound of sterling silver, now takes 184 pieces of paper in order to buy a pound sterling. And in the United States, the money's been debased so much that the value of the metal in our coin is worth more than the stated monetary value of the coin. When I was a kid, the quarters and dimes were made out of silver, as the Constitution requires. They are no longer made out of valuable metals, and even nickels aren't made out of nickel, which sounds oxymoron, and pennies are no longer made out of copper. If you want to access the intrinsic value in a coin, it is a felony punishable by 5 years in prison if you melted US money down. The other way to think about the intrinsic value is, what's the intrinsic value of a Jackson Pollock painting? It's 40 bucks, right? It's some house paint and some canvas. But Jackson Pollock paintings are scarce, and they have a 70-year track record of being a very good store of wealth. Bitcoin only has a 12-year track record of being a store of wealth, but 60 years from now, it should be able to have the same track record. And so the lack of fundamentals really isn't an issue for why one wouldn't want to be in it. The last argument you often get is it's not actually scarce. Bitcoin is just 40,000 lines of open source code. Anybody can copy it and they can make their own version of it. There are now 5,000 cryptocurrencies out there. People are making copies of them all the time. And I guess the best rebuttal to that argument is I had a kind of snarky interview with Andrew Ross Sorkin on Squawk Box, where he said he and his wife were walking down the street and they saw somebody pitching a new coin, and they decided at their kitchen table they were going to pitch their own coin and they were going to become rich, and therefore Bitcoin and other popular blockchains like Ethereum would no longer have value because there's an infinite number of variations you can do on it. And I said, hey, I got a better idea. Photo sharing. If you can get 2.4 billion of your friends to share photos on your website, it's going to be worth a lot of money. And that's really the point, is anybody can make a copy of Bitcoin, and there's been lots made, but there's already 100 million people using Bitcoin. As Joey says, it's been used for 12 years without a single hack or compromise or anything actually bad happening to it. So the network value is already built in. And I think that use case is over. That for the digital gold store of wealth type of use case, it's going to be very difficult for anything to come and take it over. On the bottom of the screen, we have a couple of examples of forks of Bitcoin. That's a non-compatible upgrade to the software is a way to say it. These are some of the more kind of well-known ones. There's sometimes some political drama around the creators and founders of these various versions. And whatever you say about the pros and cons of each of the versions that have come out, in the end, the network effect swamps whatever advancements that they're being pushed out. And so although there were always early excitement about these new forks or new versions of Bitcoin that were supposedly even better than Bitcoin, one's even called Satoshi Vision because it's supposedly exactly what Satoshi wanted. Those over time do fade and the network effects take over. Money and technology have very strong network effects. So when you have a technology money, it really is going to matter. And with that, I'm going to hand it back to Paul to wrap up.
Thank you very much, Dan and Joey. Hopefully you guys really enjoyed that